Hello, welcome to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a happier, healthy relationship with money. I want to thank you for joining us today. Again, my name is Steve Sexton. I appreciate you sharing this with your friends, your family, and your coworkers and so on. It's just wonderful. Now, we've got some really big things going on today. You know what, with all the stuff that's going on economically, okay? I'm going to be talking about the consequences of higher treasury yields. We just had Mr. Powell reverse his position and, hey, we're going to go rates higher and higher and higher. What does that mean to you? Secondly, right now we have pretty much everybody in the United States are experiencing a contraction of what they're able to spend because of inflation and those interest rates going up. And we're seeing those costs going up. And you know what? Many people in retirement are finding it harder and harder to keep it financially. And now one of the cool things is we have a 20-year veteran of the mortgage industry, Angela Wyckoff. She works for Reverse Loan Solutions, and she's here to, educate us about reverse mortgages, walk through the transaction, dispel all the myths, the misinformation. And I think that's really important, especially when you're getting to this point in life where you're going, hey, I need to do something, but not sure. I've heard a bunch of rumors and it scares the heck out of me. So, with that, I want to introduce you all to Angela Wyckoff. Angela, welcome to the show.
Thank you for having me, Steve.
First of all, I can't say enough how important it is you're here because of what you're about to talk about. We have a ton of listeners and viewers, and we on our blogs, we got a number of people, hey, what about this reverse mortgage thing? How does this work? How do I get the equity out of my house so I could use it in case I have an emergency, all that kind of good stuff. I want to say it's not a good stuff if you have an emergency, but
right.
You know what? Or just dealing with these weird economic times. One of the things that I always like to ask guests is this: what motivated you to get in this business?
So that started pretty young for me. At age 13, we had to move in with my grandmother, and I watched her struggle to take care of her mother. So it was Nana taking care of great Nana. She was not physically able to, and after a certain period, she sent her to a nursing home. Fortunately, it was in the area that we were in, but every time we walked in, it was so cold. She was screaming, thinking people were trying to poison her, and it was just a terrible experience to watch her deplete her life essentially by going into that. And had we had the ability to bring in-home care, her end of life experience would have been a lot more pleasant.
You know what? I can understand how that would motivate you to do what you're doing right now.
Yeah, I love seniors. They essentially built this country, and just watching that struggle that early in life was like, I've got to do something about that.
Okay, so here's the first question for me. You've got 20 years experience doing this. So many people utilize a reverse mortgage for many different things. What are you seeing them use it for? I understand the emergency, like with your family went through, and I get that part, but what about the other things?
So there are so many ways to tailor a reverse mortgage. There are no two that are alike. It's very, very tailored and specific to your needs. And the problem is that people call an 800 number, they get an order taker on the phone whose only goal is to maximize company profits. And I'm here to talk to you and have the real conversation. What's the pain points? What's the goal? And let's structure this so that it benefits you and your heirs the most. People can pull a lump sum out of the property. You can support an income gap. Like if your Social Security isn't covering it and you have a deficit each month, let's split that up into monthly payments. Or you can have a rainy day fund, a line of credit that grows, that gives you access to more funds the longer you leave it there. And in a high rate environment, it's actually a positive thing because it actually grows at a much higher rate. So taking advantage of that is definitely key. I make less money, but hey, I can sleep at night. So I try to structure these with integrity and in the best interest of the senior.
So, you know what? It's really interesting when we started looking at reverse mortgages with our fan base. and our listeners, and we say, hey, you know what do you hear? And you know what, you hear all the junk like, hey, the bank owns my house, my mom passed away, we're going to lose it to the bank, all that kind of stuff. So I'd love for you to just take a moment and dispel some of the myths and misinformation that comes out there. The first one, which is, and the reason why it's the first one, because I got like 30 emails that almost said the same thing. And it says, you know what happens if my mom and dad pass away with a reverse mortgage? Okay, does it go to the bank? What happens?
So the bank never owns your home. Let's put that out there right now. You still retain title just like you would with any other mortgage product. The reverse mortgage does have to be paid off, just like any other loan against the property, and any proceeds that are left go to the heirs. If there are no proceeds, which does happen, then it's a wash, and I would send the keys to the lender and let them sell it because there's no profit in it. So it's important to have these conversations up front. What is the intention? Are you intending on leaving the home to the heirs? Does anyone want to occupy the home? Because they have the ability to either refinance it into their own reverse mortgage if there's enough equity, or purchase it with like a forward mortgage. So there's definitely options. And what I do is I go over the proposal in depth, and I show them what their equity looks like from day one. So they know at age 100 what they're expecting and how that's going to impact their heirs.
Okay, so I have another question. Back in 2008, when the whole real estate market got punched in the face, almost like knocked out, there was people who had really high reverse mortgages, and the reverse mortgage was probably $100,000 or more over and above what the value of the home is. And then somebody passed away. How does it work with something like that? I mean, do they just give it back to the bank? Or my understanding back then is it was like a portion of a percentage of or below the appraised value that they were able to purchase the home.
Correct.
Okay, so explain that.
95% of current market value is what the heirs are allowed to purchase the home at. So if the case comes where the property it does owe more than it's worth, it's a wash to the heirs. The heirs don't get a bill in the mail for $300,000 or whatever it ends up being. I have people often call me and they're all like, you know what, my kids are successful. Honestly, I'll be dead and I don't care what happens. So, I get people that are painfully honest with me. And, again, being a non-recourse loan, the balance can exceed the value, but the bank is never going to go after the heirs or send you a bill. It's a wash and send the keys to the bank.
Okay, so for example, I did hear of stories back in 2008 where people were buying homes at pretty much half the value of the mortgage because of that 95% rule, and they actually turned around and made money.
Yep, you can.
So, okay, good. That's good to know, because you know what? We're in a weird economic time. And right now, when you have real estate rates at 7%, it makes it very hard for people to buy a home if somebody's in trouble. And people who were in trouble, because of the COVID and all that stuff, are starting to work their way through the foreclosure and all that that process. So we might have more houses, the housing prices might go down in value. So I was just curious about that. Now, there's a big question here. Hey, reverse mortgages are really expensive. That's the number two.
It is. And I hear that a lot. And I can somewhat agree. However, what I do is I try and explain the value of the cost. So, for instance, there are FHA insured mortgages or reverse mortgages, and then they're proprietary. The FHA insured mortgage has an upfront mortgage insurance premium, which is 2% of the value of the home. This amount that's collected, this 2% upfront, protects you or your heirs from ever owing more than the property is worth. So remember how if there's a $300,000 deficit, if you paid, let's say for instance your value of your home is $500,000 and you paid a $10,000 mortgage insurance premium up front, and by the time the last borrower passes, there's an overage of the account of $250,000. Who's gonna pay for that? Remember that $10,000 you paid up front? That's an insurance policy to essentially protect you from that. Also, there is a 0.5% collected each month in mortgage insurance premium, and that protects the credit line that you opened or the monthly distribution that you set up. So when you say that these loans are expensive, expensive compared to what? So if you sold your home, you're going to pay 6% commission to a realtor. If you wanted to stay in your home and avoid having to move and, move 35 years of, tchotchkes or what have you, it's a lot more affordable to use your home to
Mhm.
stay at home.
I think the big thing there is people didn't realize what they're paying for what they get.
Correct. And
They just
that's
heard.
why I take the time to explain it, because a
Mhm.
lot of people say, oh, I don't want to pay the mortgage insurance. Well, that insurance is a very, very small price to pay to live in your home for as long as you live in your home. And it's all based off life expectancy. And they're using tables from like 1987, and we're living a lot longer. Retirees are living 15 to 30 years, after retirement, and their income is not going up.
Yeah. You know what, Angela, we're gonna stick right there. We got to take a break, pay some bills. So everybody stick with us. We'll be right back with more Angela Wyckoff. Perfect.
Yay.
Cameron, we just finished segment number 1 with Angela Wyckoff. We're gonna move moving in segment number 2. And 5, 4, 3, 2, 1. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a happy, healthier relationship with money. Now, I hope you're enjoying all this. I truly want to thank you for tuning in and appreciate you letting your friends and families know about the Saving with Steve show. All the replays are available at www.savingwithsteve.us. If you're enjoying the stories of helpful information and insight on Saving with Steve, then I encourage you to subscribe to our YouTube channel. Never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, UK Health Radio, BBS Radio, Talk Radio New York City. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal and financial freedom. You can also follow us on Facebook at Saving with Steve Sexton and get the behind the scenes stuff. You can see all my flubs, as well as everybody else's flubs, or cats walking across the screen, all that kind of good stuff. Now, with that, I want to welcome back Angela Wyckoff, Reverse Loan Solutions. We've been talking about reverse mortgage, dispelling all the myths and misinformation. And the cool thing about it is all of our viewers are sending an email saying, I want to know about this. So now let's see. I just got a kick out of this one. The bank tells me what to do with my money. So
Not at all.
yeah, let's just, now here's the other one. A lot of people are very, very concerned about this. And when we first started searching for somebody that could help us and educate us on the show about reverse mortgages, one of the questions that says, hey, if I have a reverse mortgage and my property goes down in value, will they take away the portion of the loan? Will they take away some of my funds? What occurs there?
So that goes back to the important question that we were talking about, is how expensive reverse mortgages were. Remember that, mortgage insurance premium of 2% that we didn't want to pay? Well, that is what protects you. If the value goes down and you're ever upside down on the property and you were promised payments of $1,200 a month or what have you, that's protected. That's that insurance policy that you paid for up front, that 2% of the value at the time you established the reverse mortgage, that protects you from continuing to be able to access your line of credit or receive your distributions or however you ended up setting up.
Out of curiosity, those payments that are set up, are they inflation adjusted at all?
No, they are static. So for instance, at the time you set up, you can say, I can tell you how much is available, and you can say, oh, you know what? I kind of want 30,000 right now to do some repairs around the home. And then we could take what's left and distribute into 10-year payments. So if you live longer than the bank expects you to, you're getting a lot more. I had a client call in and they had spoken with somebody on the TV that they called because of a mustache, and they got a telephone jockey, and they're like, well, they're going to give me $200,000, and I'm all like, oh wow, that's amazing. What are you going to do with that $200,000? And he's like, well, I'm going to take 30,000, make some repairs, repair the roof, etc. I'm going to put the rest in my savings account and withdraw $1,000 a month for my wife's life and long-term care policy. She had Parkinson's. And I said, why would you pay interest on that from day one? So I was able to get him the $30,000 at closing. I was able to set up payments of $1,500 a month for tenure of the loan, whenever the last borrower leaves the home. And instead of $200,000, splitting it up that way, he, by age 100, would have received $478,000.
That's awesome.
Yeah, it's amazing. It's such an amazing retirement tool, and I've made it my passion to dispel all these myths because it's so amazing.
Well, the big thing here is this: doing some planning with somebody makes all the difference in the world. So if you're looking at reverse mortgage, whoever you're talking with, if they're just doing quote and verse, that's not going to work. You need to understand exactly what you're getting into, what you need it for, how it's going to benefit you, and what's the long term all about. Because if you did, and most people, and what my understanding is, I don't do reverse mortgage, but when you're in the financial field, if people understand the upfront now, down the road, and what the benefit is and what they're paying for what they're getting, it becomes a lot more palatable. And you start saying, okay, all those things that I've been hearing aren't quite true. Now, one of the things that a lot of people are asking is, you know what, should I get a HELOC instead of reverse mortgage? You know, what would be better? What's the difference? Does that make sense or not?
Okay, so a HELOC versus a HECM, which is a home equity conversion mortgage. So the HELOC only has a draw period of 10 years, and you have to make interest-only payments. The HECM is for as long as you live in the property, so what, 30 plus years, and there are no payments required. You draw as at your leisure, and you can pay back too, just like a credit card. You could do that to, kind of postpone the interest accumulation. So you can pay a portion of it back, but the longer you leave it in there growing, the more access to funds that you have. Oftentimes when I'm doing my proposals, within 10 years, the amount doubles. So if you had 200,000 in a line of credit that was going to be available to you, and let's say you're young, you're 65, and you want to use it for your rainy day, or you have some health issues that are going to be coming up, and you want to be able to use that when the time comes, because it's not if, it's when, 10 years down the road, when you're 75, there's going to be like $400,000 in there.
That's wonderful. Okay, so where did that go? I just had this wonderful question.
Can we talk about the rules?
Well, let's talk about the rules, but I also want to talk about one other thing, and we have about 4 or 5 minutes to go. And this is a very important thing because we've had some people that says, hey, I thought everybody qualified for a reverse mortgage, but they didn't. So what are the things that make sense about qualifying for a reverse mortgage? And then, obviously let's walk into the rules.
So the rules and the qualification essentially go hand in hand. So rule number 1, it has to be a primary residence. You must live in the property. You can't rent it out. If you have, let's say, for instance, you have a married couple and one goes to assisted living, as long as one borrower remains living in the property, then you're still, submitting to the rules. Rule number 2 is that you have to pay your property taxes and your insurance. You have to maintain those. And you have to maintain the property. So the property can't go into disrepair. The city can't come by and condemn it, or if somebody owns like a 5-acre property, they might not be able to maintain it. We might want to consider maybe selling it and taking the proceeds and doing a reverse for purchase. So you can do that too. So that's essentially the rules of qualifying. Now, you can qualify for a reverse mortgage a lot easier than you would for a forward mortgage because there's no P&I to qualify for, right? So you have to qualify for your taxes, your insurance, and whatever credit debts that you have. And in some cases, you can pay off those debts through the loan to qualify. And of course, having that conversation as early is necessary, because as the values start to level off and or reduce, you might not qualify for as much. So definitely having that conversation while the values are high is important.
Okay, so let's see. Let's talk about the high rates. We know our rates are up. What are rates for reverse mortgages?
They're pretty well in line with conventional rates. So for instance, I literally just had one where it was like 6.875, which is what I'm selling on forward mortgages as well. So it's very, very well in line with that. The fixed rate reverse mortgages, though, they are a little bit higher. They're closer to 9.99. And the higher you go in the interest rate, the more funds the lender is willing to give against the property. So these are all things that we talk about. We talk about the various options. When I do a proposal, I always show you the adjustable, the fixed, and then of course, based off the goals, how to properly, take the most advantage of each individual loan product.
So did you hear that, folks? Very, very, very important. You want to see all aspects of every single loan, not just the one that somebody's presenting to you. Too often in any business, especially when you're in the advice business, so there's a lot of people who just have a cookie cutter box. You don't want the cookie cutter box. You want somebody who's going to adapt something to your needs and give you an idea of what's possible. That's very important, because if you're looking at something and you actually need a larger loan, hey, that higher rate might make more sense. Or if you need something that's an income, it all depends on what you need. So it's really important that you look at all the different aspects and you have somebody like Angela to do that. Hey, Angela, we're about wrapped up here, but I need to know how people can get a hold of you.
Absolutely. You can reach me at 805-301-1933. That's 805-301-1933. You can call or text, or you can shoot me an email, angela@reverseloansolutions.com.
Again, that phone number is 805-301-1933.
Correct.
Perfect. Folks, you want to make sure you check out Angela. Angela, I want to thank you for sharing that information with us today. It made a big difference for a lot of people. So
thank you so much for having me, Steve.
I want to again thank you for being here, and stay safe and stay healthy. We'll hopefully have you again soon.
You too. Sounds great.
There we go. Cameron, here's my segment. Here we go. Segment number 3. Hey, welcome back to the Saving with Steve show. Again, we're talking about the ins and outs of money. Today, I'm going to be talking about the consequences of higher treasury yields. So I've been sharing with you guys over the last few months the rise in treasury yields are caused by the rise of inflation. However, it's worth noting that the rise in treasury yields has a far more systematic consequence, and that is the U.S. is paying a whole lot more on its debt. Think about it. On Monday, the U.S. issued $48 billion worth of 6-month T-bills. Last time this year, based off where the yields were, the U.S. would pay $180 million in interest on these bonds. Okay, think about this. Today, the U.S. will pay $1.3 billion in interest on these bonds. This is just one tiny example of this issue. And this issue will apply to all the debt the U.S. issues going forward. Higher rates means higher rate payments. The U.S. has over $31 trillion in debt, and it's adding to this mountain of debt via the $1 trillion deficit that we've already known about this year. So we're going to be talking about greater and greater debt payments on a mountain of debt, which will need to be repaid or rolled into something in the near future. What are the implications and consequences? Think about it. There's so much broken economically. And you add in the monetary policy right now, we will face consequences sooner than later, and it won't be pretty. The more we kick this can down the road, the more painful the consequences will be. And you know what? Not only for the economy, but the markets. In fact, most recently, we've got the Fed chairman, Mr. Powell, in his speech indicated that rate hikes will increase higher than originally thought, because he wants to make sure he gets inflation rate down to 2%. And as a result, the markets are repricing. Wall Street analysts are indicating the higher the rates, lower earnings decline, resulting in higher layoffs, moving us more and more into a recession. We even have major brokerage houses, their chief of equity strategies are indicating U.S. stocks have climbed to unsustainable highs and face imminent losses once investors realize what we just found out from Mr. Powell, that the Federal Reserve isn't pivoting to lower rates later in the year. Folks, here's the big question you want to ask yourself, especially if you're about to retire or in retirement. You're taking income. Are you using the right tool for the job? Are you using an accumulation or a growth strategy for the distribution phase of your life. This could be very problematic and is also the number one reason that people face this dilemma with their assets being cannibalized away when they're withdrawing in a declining market. And many times, most people never recover from it, which is causing change of life. So it's really important that you proceed with whatever you're doing with caution. Hey, I want to thank you for joining us today on Saving with Steve. This is my little Money Minutes segment for the show. We'll look forward to seeing you next week with another great episode. Stay safe and stay healthy. We're going to see you next time.